There's a lot of ways to skin the cat as far as values go in a business. Some are more ethical and virtuous, right? Hey, we tell the truth. We have a gold standard of, always trying your best or high performance, right? Those sides. And then the other side of values is how you do things specifically in the business, right? So it's more process oriented. So at Saint, we lean into both sides, obviously, right? I'm proud to brag on my team all the time, but we have a few core values. Things like when we hire, that new hire has to raise the level of the whole team, right? So there's a whole team, we have an average level of whatever that is. The new person has to bump that up, right? So we don't want to ever go backwards. The natural tendency is in business, I truly believe 100%, is that you get the average. Because if you go through a hiring process that is average, and you end up hiring someone that's good enough for that period of time, and you do that over and over, you wake up with an entire team of average people, right? And that's great. Average people are great. We need everybody, to make a country work. That said, that's not how Saint works, right? We have a very high bar. I believe that what you tolerate becomes the norm, right? And so on our side, we have a very high bar for that reason.
You get what you tolerate.
Exactly right. More eloquently put, but it's your bar of tolerance. It's that floor, right? You have your ceiling, maybe your stretch goals or maybe the end goal, but the floor of working with the best freaking people. And I've been in businesses where it was very frontline worker oriented, and there was a huge portion of that hiring was just. It was making sure you always had roles filled, and that's a whole different business model. But where we're at, we work with 9-figure investors regularly. We work with very high net worths. We work with huge 8-figure, 9-figure structures with things. So how could we not go after having the best employees? So virtues, that's kind of in line with what our virtues are as a culture in the business. And then you want to talk virtues as far as how we do things, systems and process oriented. You hit the nail on the head. Very data driven, very economics driven. Again, we're in the investment space, and both of those were learned by banging our heads against the wall or getting slapped around by the market at different stages, right? So now today we have economic spreadsheets that are 15 pages long. We have KPI tracking that's 10 pages long, exhaustive tracking. But when we overlay that and we dig in as a team, we find insights, we find stories or opportunities that we wouldn't have seen otherwise if we didn't have that data, if we didn't track those trends. So that's kind of both sides of the virtues on what we're looking at with things. We're seeing a ton out there right now. And I think we are living in the biggest time of opportunity that we've seen in probably since 2008.
Amazing. Well done. There's something that you hit on multiple times that I think requires a little bit of digging. Is you said when you hire, it's not just a process, but they're supposed to level up the team. That is called bottom-up leadership, where you don't need a title to be a leader. And I love that you employed bottom-up leadership. It's something that I talk about at every leadership summit. When I'm booked to speak on leadership, I ask the people, what does your leadership hierarchy look like? Obviously, you have someone that runs it, is steering the ship. You have the captain, but then you have let's use the military language. You have your captain, then you have your lieutenants, and then you have your people underneath there, right? Cool, got it. Like that's the hierarchy structure. However, does your leadership belief system believe in bottom-up leadership or top-down leadership? And they'll always tell me like, well, we really focus on the top-down, like it has to filter down, all the. I was like, so the bottom guy just is working and that's it. And they're like, well, we really empower them, whatever. So they're telling me that they are a top-down direct leadership, meaning I give you an order and you follow it. That is the military way. However, the military also teaches that you don't need a title to be a leader. And that every single person at the lowest level, it's called bottom-up leadership. A lot of businesses do not do bottom-up leadership either because they don't know what it is or they don't think it works. And you, my friend, have exercised the exact strategy that should be used where it's bottom-up leadership, that if you need to level up the team, even the lowest guy and the pecking order who may not have as much experience, but brings that something that the team needs, that one little ingredient that makes the team just a little bit spicier, a little bit faster, a little bit more exciting, and just breathes the air that they did, because you never know what you're missing until you find it and go, oh, this is amazing.
I love that. I love all that. I'd say that, so the question that we run into that on that side is, because I agree with everything you said, the question is, how do you systemize that? How do you recreate the magic over and over, right? So, I had this early on. I had some really, really well-performing real estate deals that we purchased, ridiculously high returns, and everybody was very happy. And the problem that I ran into was the high watermark that I set. Investors were basically like, Nick, well, we want those returns, right? And I'm like, well, that's a function of the market at that moment of time. That's a function of, rolling the dice and finding opportunities in that. And they said, well, how do we recreate that magic? And that really put into my head that huge success is great and you must do it. And it takes a lot of trial and error, and it takes a lot of banging your head against the wall and really running through walls, if you want to be honest. But the back end of that is, how do you document that in a system so that you can recreate the magic the second time and the 2000th time? And so we've really spent a lot of time nailing down our hiring process, our sourcing process for talent. So we're always looking for the best people so that we can enforce our own standards, which are that the newest hire must raise the bar on the whole team. I think it keeps people on their toes in a positive way, where it's exciting, it's not threatening, right? But the expectation is that we're all learning, we're all growing, we have growth mindsets, nobody's stagnant. KPIs from yesterday are not what we're looking at tomorrow. They're always going the right direction. And so that's a value system, right? That's a system to improve values over time. And I thought that's very interesting. We typically, for a role, will go through something around 2,000 applicants, just to give you an idea. So that's what that looks like on our side. But again, we're dealing with 9-figure problems, right? So if I think that, we're so unique and we have such an exhaustive system, Blackstone, right, or Microsoft, they're snatching A++ students directly out of college with 4.6 GPAs. They're skipping the line on all this stuff. So I'm just trying to keep up with what the top guys are doing and get as close to that as we can.
What you want? Or is it just that you've made a name that 2,000 people want to work for you? How does that even happen?
So you mentioned top up, bottom up. Bottom up leadership, bottom up organization. I think that's very strong to always be raising the floor, right? And that the standards always increase. So me on my side, the two things that I joke about with my team, one is that I'm like, hey, I'm just the doorman. I'm just letting the right people in the building, right? And that's a joke. They know I work very hard and spend a lot of time making positive that I'm supporting them and giving their roles. But the other side is I'm obsessed with growth. So I'm trying to be on the very back end of all efforts and the very front end. The very back end of all efforts, where I'm trying to give my team the best resources. Sometimes that's personnel, sometimes that's tools. So whatever that is, oftentimes it comes from them what they need from me to support, right? So I'm trying to push forward from the rear, right? And kind of shoulder it. And then I'm trying to be at the tip of the spear on the other end. On the growth side, I'm extremely involved. So one of the things that we excel at Saint, and just one of my natural interests and abilities over the years in business, we've spent a lot of time on marketing. And what I found is that marketing doesn't end to only get leads or to grow your business in a certain way. It's internal, right? We name a lot of things really interesting, different initiatives that we have. It's team marketing to ourselves. It's reminding ourselves of what our brand stands for and what our opportunities that we're looking at, why we do the things we do. And so I'm very close to the growth side, especially when it relates to, lead generation, nurturing of those leads and how that goes, that we're telling the right story, we're getting to the right people, et cetera. And I found having the best people in the middle has been the strongest, right? I mean, you're a veteran, my right hand is he's a ex-Marine, right? So we understand each other from speaking slightly different languages. I'm an entrepreneurial dog from a very young age, so it's like we speak the same language but a little different dialects, and it's been really, really, really positive to have that structure.
That's amazing. That is incredible. I wouldn't want to be the person reviewing 2,000 applicants, because then you got to whittle it down, right? And then you're like, oh, this guy's awesome here, but this person might be cool here, and like, oh man, like trying to whittle it down to maybe like one, maybe like two people has got to be like agonizing. So I wouldn't want that. Although, if you think about it, that's kind of a cool problem to have. That 2,000 people would apply for this one job and want to work there. Like, very, very, very cool stuff. So that begs the question. It goes into why Saint Investment Group. What did you create? I get it, real estate investment firm. We already talked about that, but like, what did you create?
Yeah. So Saint Investment Group, we're an investment manager. We're an investment sponsor. So what that means is it's a little bit about our background, right? Really, I wanted to be close to real estate. I wanted to be close to the big dollars, the big deals, the big opportunities, because I knew from a young age, hey, I want to be close to all these opportunities, but they were off market. There were people doing this that we didn't have access to. We, as a country or as civilians or as individuals, didn't have access to the best opportunities in finance and investment, right? It used to be the stock market, Sean. It used to be the stock market. And again, everything I'm saying is 100% my opinion, although I'll throw around some data points so people can make their own conclusions. But when I say the stock market's broken, there's a few reasons for that. One is the stock market used to be the great equalizer for investment. It used to be that all of us as citizens could invest in the stock market. There weren't hurdles to do that. We had access to the same companies, the same opportunities. That is not where we're at today. The stock market that we see today, I want to be very clear. I think it's crashing upward. Okay. What I mean by that is if you look post 2008 and you look at the top companies and what percentage of market value those top companies held, and then you look at the market or the top seven today, the Magnificent Seven today, it's exponentially higher today than it was post 2008. That's one number. Second number, since 1995, the stock market, the New York Stock Exchange, has lost over 40% of the number of companies in the stock market. So the stock market is actually shrinking dramatically. 40% is almost half, right? So substantial numbers. So what does that mean for us as investors, as citizens, as people that want to get good returns on their money? It doesn't mean that there are less investments. As a matter of fact, there's more investments than there's ever been. There's more opportunity than there's ever been. It's just not available to the public. So early on in my career, meaning it went private. It went to private instead of public. Public being stocks and equities, and private meaning guys like me, guys like our company, guys like Saint, right, that put together private investments for investors, and we find the best deals and we source the best opportunities for our investors, right? So in the wake of the 2008 crisis, when I was going into the investment world, I saw that there was this big shift. A lot of things were going private. It was becoming obvious that, some people were making ridiculous returns and other people were getting crushed by the stock market in the wake of 2008. So I go like, how do I get closer to the winners? That seems a lot better than this other alternative. And I'm already broke and I'm already a student and I already have no money. So I don't really have a whole lot to lose by throwing my hat into whatever the ring with the biggest winners I can be close to. So what I found after many phone calls, after many rounds of trying to get in and get an inroad, I connected with two family offices, smaller, right? But net worths, of the offices in the hundreds of millions, and connected with these individuals and worked right next to the CEOs. And I got to learn firsthand what they did, multi-generational wealth, multi-generational, best practices, best strategies. And then I said, well, how can I add the most value to y'all? And it was go to the acquisition side. So now I'm learning from multi-generational talent that's multiple 100 million net worth. And I get to go into the acquisition side and learn how they buy and how they purchase and how they find assets.
It's valuable.
So invaluable. And by the way, I worked for free, right? And I earned way more,
right?
than I could have ever been paid, right? So that's what I did to get my start. Over the years, we bought so many projects that I had discussions with the CEOs and said, look, do you need help on the asset management side? Let me start Saint Investment Group and basically be a hired partner to asset manage. Eventually, we started raising our own money at Saint around 2015, and started working with numerous investors. Now, portfolio's big, lots of loans, lots of amazing partners, lots of great investors. So that's a little bit about what we do, why we do it, and where we're at today.
Why Saint?
So I mentioned that two things. One, I mentioned that I started buying properties and assets. So I was on the acquisition side. I went and found opportunities. The second is that I said that I was in the wake of the 2008 global financial crisis. That means when you bought deals at that time, they were always messy. Okay. They were always messy. So when I went and bought an asset, most of the time it was in some degree of financial foreclosure or some huge issue that was going on with the property. Very oftentimes it ended in messy legal situations, but we were making huge returns. There was huge opportunities, and somebody wasn't paying the bank. They weren't paying their bills, simply put. I didn't love that situation for that reason. I liked the returns. Those were great. I liked the situation, working with great people. I knew that somebody would have to foreclose on these people, and in these big industrial buildings or big commercial buildings. We didn't do houses, by the way. So we weren't evicting families. But it was, a big business that the guy hadn't, the CEO hadn't paid the bank in 18 months. What did he think was going to happen? Right. And so I didn't love that scenario. It's not what made me really feel fulfilled to step into that. I'm not saying we would never buy distressed assets in that way again, but it wasn't my preference. Instead, what we did, we still had all the connections. Busy weeks, I was buying up to $10 million a week. I had $10 million in cashier's checks in my jacket pocket. I was probably 23 and a half, right? And I'm working with banks. I'm buying at the courthouse steps, these huge projects. I had my work boots on. I used to do construction. I still was wearing my work boots with $10 million in my pocket. And I'm sitting there thinking, I still have these connections. I still have these people that I know. They know I'm serious. They know my partners are serious. How do we utilize this in a way that's better than the messy, not feel good side? So what we did at Saint was we leaned into that. And instead of buying distressed huge properties that, had a really messy legal battle in tow, what we did was we started buying mortgages for single family houses. And instead of foreclosing and kicking people out, we just basically gave them the terms that they needed to stay in their homes, right? So most people realize that the returns are probably higher by foreclosing on people. I don't like that. What I'm looking for is 10 to 20 years of returns and keeping the family in the house, because at the end of the day, that family's more likely to pay if their kids are there, they have memories in the house, they have all this equity. I don't want to evict or foreclose on those people. I want 20 years, 30 years of payments for Saint and our investors. So we went a different route. We started an income fund, meaning we pay a set amount to our investors. We pretty much know exactly what we're going to get on a monthly basis from our mortgages. Our performance after helping all these people is around 96.7% of on-time payments, because we say, well, why can't you pay? Why aren't you paying? Well, my mortgage is $1,500 and I can only afford $1,000. Okay, great. We're going to give you $1,000 payment. We have to extend your mortgage by a handful of years. Okay. We might have to adjust your interest rate. We're going to make some changes, but we'll hit your needs so that you can stay in the home with you and your family. How does that sound? Most of the time that sounds great. So at Saint, we had the skill set, we had the experience to have access to off-market opportunities. And we wanted to merge that with a little bit of a better way to do business where we feel good. We get to keep Americans in their homes, right? And we get to be an outlet for banks for distressed assets that they don't really want anyway. So that's kind of the full cycle of where we came up with the name and what we do behind that.
Absolutely incredible. And I know someone who does, what is it called? Distress notes. And he has a podcast called The Note Closer Show. You know who I'm talking about?
Oh, I'm trying to place the name to the show name. But yes, it's a small world. The note space or distressed mortgages or non-performing loans, all the kind of the same terms. But yeah.
Small world. I don't know if you've been on his podcast, but he's a very good friend of mine, and his name is Scott Carson.
Yeah, I do.
Yeah.
I'm aware of Scott. I don't know.
Yeah.
I met him personally, but we're not close personally. But yeah,
I'll
he
make
has
an
he has
introduction.
a big show. Yeah,
Yeah, I'll
absolutely.
make an introduction. Perfect.
Love it. I love it.
So let's talk about launching. A lot of people, when they're talking about launching, they just say, "Oh, we had to prepare things for the market to receive us, and we had to do these certain things and come up with our valuation or whatever." And I'm like, okay, again, how did you launch? Like, yes, that's part of it, but like the launch part is where people mess up all the time. Processes are broken they didn't know were broken. The lack of systems that I see as a business positioning strategist, there are so many processes that they didn't even know existed that they should probably have in place first. So talk about your launch process. You got the name, you got the company. Did you design the category that you would play in, or did you just go to market and let the market break it and fix it? Like most everybody when they build businesses.
So you just talked about the dark side of entrepreneurship, which is sometimes you're stepping into the ring and what you think is your best foot forward, and the market beats you up and you have to go back to your corner and regroup a little bit and change game plan. So it's always going to be a piece of that. Like I said, the economic side, the reason that we're so insane about economics, we overly drill down on so many economic data points, is because we've bought deals that we thought were, hey, we bought 60% off the purchase price. Or to market, we brought a 60% discount to market. How do you lose? Well, we figured out that it was a declining market and it was going to be brutal for probably 10 to 15 years ahead. We got out of there as soon as possible because we almost got caught, with our hand in the cookie jar in a bad way, where the market almost stuck us there for another decade. Yeah. So by the same token, we didn't want to do that when growing a business, right? So I'd say it's equal parts trial and error in the sense that I'll brag on my team. They have a lot of experience in real estate. They have a lot of experience with funnels and conversions and marketing and growth opportunities. They have a lot of experience on the nurture side. And then the whole other side of the business is asset management, where we've been doing this for a very long time. I don't know, 15 years. So we have a lot of experience where we can kind of cut the line a little bit of the natural progression of having to learn every single hard way of doing things. That mixed with the other side, which is product market fit, is never more important than it is today. If you build it, they will not come. I just want to say that. Just because you built it does not mean they will come. So what that means for today is that you have to be really confident that what you're selling, someone is buying or solves a problem for someone else in the marketplace. For us, it was actually easy. This was one of the freebies that we got, is we had a large investor base, very successful people, and they told us what they wanted. They said, hey, we were the baby boomer generation that was killing it in the workforce with the baby boomer generation is the largest and most wealthy that we've ever had in the US. That's around $70 trillion worth of wealth that they hold today. When they were in the workforce as the largest and wealthiest generation, they were all competing for yield. They all needed return on that huge amount of money that they had in the workforce in the last 15 years or so. They've transitioned now, especially COVID sped this up. Most are now in retirement. They're taking their money with them. And instead of wanting the highest yield that they can possibly get, they want the most stabilized and conservative and lower risk and consistent payout. So that's why we created an income fund. On the other side is that's what our most sophisticated, most early adopter, most far seeing, right? They were seeing around the corner a little bit. They were seeing into the future a little bit. That's what they were asking for. So us creating a product for them, which is a fixed income fund, was a product market fit that we didn't have to work that hard for. Whereas someone else just stepping into a marketplace, they have to be much more confident in what they're doing. They have to very much test that and make sure that lands well with who they're going after.
Yeah. Again, being very data driven, you have the opportunity to see things that people don't, and you can crunch the numbers. And I'm wondering, do you have like a number that's like, by the time we invest and maybe we got to do some upkeep or something like that, unless you're just buying foreclosed warehouses in the middle of Chicago with no windows and you're like a wholesaler, right? With a little picket sign at the end of the freeway saying, buy our distressed property, like that type of thing. I would assume there's a little bit of money that needs to go in there, a little bit of, some upkeep and some other things, get it ready for market, put a nice coat of paint, put a nice red lipstick on the pig, and then try to sell it, right? So is there a number that you're like, look, it's got to be above 30 to 40% returns?
So that's a great question. There's two sides to the business, but the fixed income side, the income fund, really the returns are, I don't want to say less important because they're very important, but we are not trying to get the highest return. We are trying to get the longest track record ahead. We want, again, 10, 20, 30 years of payments ahead. We want the very, very, very highest amount of certainty in those investments. We want, we want the lowest possible risk on
guaranteed
that.
income.
So we're looking, we could never guarantee anything, but we want to get as close to that always as we possibly can on our side. And so we've never missed a payment in over a decade to our investors, so we always brag on that. But that's because we're looking for very conservative things. We target around 18 to 20% returns on our side, and we pay our investors a fixed return of between 12 and 14.28% returns, because depending on the share class, because we can constantly deliver on that and reinvest with those numbers and bolster the amount of mortgages and the conservatism of that fund. So, I mean, I could brag on the syndication side, which we did for many years and we'll do in the future, but those returns we've done, 35% returns, right? But those carry a lot more risk. Those adjust. Instead of a 5-year term, it might be a 7, it might be a 3, depending on market conditions. And the Federal Reserve's lowering rates right now. That shakes everything up, right? We don't know exactly how it will play out. It seems to be very positive. It looks very good, right? But we don't know 100% how that will play out over the next 2 years while they lower rates.
Absolutely. Have you ever heard of an app called Arrived?
Arrived? No. Well, it sounds familiar. I haven't used it. I definitely haven't used it.
There's a couple out there, but this one is the hottest one.
Okay.
Where you buy fractional shares of real estate investment properties, like houses mostly, but they're getting into commercial real estate where you buy fractional shares, and instead of investing in the stock market, you invest in real estate using shares. This is
very interesting.
This is the newest. Yeah, it just came out. Like, I just heard about it literally in the last, probably over the summer, and doing a little bit of research on you and what you're doing, and then doing research on like the market and the real estate. That's intriguing to me as because I invest, I've got stocks, I've got probably 20 different cryptos. I've never done NFTs, but I've done other like business investing and things like that. Got my return and got out. Like, I'm going to give you money. I want my money back plus interest, whatever. I got that money. Thank you. Handshake. See you later. I've done that stuff. My thing is I buy and flip defunct podcasts. That's
amazing.
That's my thing.
I've never even heard of that niche, which means you're probably killing it, right? Because you're
a little bit.
You're all your boots on the ground with that. That's killer.
Well, the thing is, like, people want to start a podcast, but they don't know what podcast to start. So we can launch a podcast for you, or I have an already established podcast with an already established subscriber base, with an already established, you know what I mean?
Oh, I love that.
I might buy the podcast for like $1,000, and they've already got subscribers. They got like 11 episodes. Now, do I want to delete every episode and start over? Not really. So I keep those episodes, and then we do a relaunch episode and say, hey, we are the new host. This is what we're doing. Then, all of the go back to the, and we're going to listen to the episodes, But now I'm looking at, like, what if there was an app for that? What if there was a podcast marketplace app where, like, you can do ad spend, sell your show, like it's kind of like the app Upside. You know, you have the Upside app or the Free Up app, where it's like, I'm selling my washing machine. What if you had like the properties or the invest? Like, I'm thinking that there should be some kind of an online marketplace, not Facebook or eBay, where you sell assets. And I just saw this Arrived app, and they do, you know, fractional shares or whatever. And so you're owning a piece of like a house, but like 20 other people are too. I don't know how that works, but pretty cool stuff, man. The world of investing.
I think the world of tokenization, the world of fractional ownership.
Yeah.
I think there's a lot of tests being done with a lot of different asset classes. Yep. We'll see how those shake out, but it's very interesting. These ideas never occurred to anyone, you know, 10, 15 years ago. No, it's not a discussion.
No, because you built wealth through going to college, getting a 4-year degree, and spending 50% of your income on your house and cars and everything else. And then 30% was for savings account at a 0.0015 return rate with maybe like a 6-month CD to a money market account, which then you could do all these other, you know, investing or whatever through your money market account. And the remaining 20% was what you entertained on. So the gas going to the beach, the $16 it took you to get in for parking or something like that. The 20% is what you had fun with, but the 50% were living expenses and the 30% was investment. And maybe when you're 65, you've got about 20 to 30 grand that you can distribute through your family.
Yep.
And you've never struggled to pay a bill. Like that was people's wealth, not millions of dollars. You know, I got a friend of mine, this guy, Matty A. He's on the show, and his episode will be coming out. He does big, like you, man, 8-9 figure. He's a broker, but he also is an investor, and he does like shopping mall, you know, like strip mall retail stuff. Yeah, retail. It's commercial. I mean, millions of dollars. Hotels, like it's crazy. Matt Aitchison, hell of a dude, super good guy. So Matty A was telling me, he's like, just because I have a net worth of $1 million does not mean that I have $1 million sitting in my bank. I wish I had $1 million sitting in a bank account. And he reaffirmed, he's like, wealthy people keep their money in real estate. I'm like, okay, and what if the real estate market crashes? He's like, it's never going to crash like people think it is, to the point where you go to zero. It's never going to go to zero. It's going to be worth something. The whole game is investing in something that is worth little to holding or selling something that is worth a lot. Because it's like stocks. If I buy a stock at $5 and it goes to $4.50, I'm losing money. I should probably sell it, or maybe I should wait till I get back to $5 and sell it and maybe break even. He goes, that's the game. We're just playing on a bigger scale. He goes, if I spent $1 and got a 40% return, I'd have $1.40. If I spent $1 million and got a 40% return, I'm just playing with bigger bills. That's all I'm doing. Yeah. I'm like, huh? So when you break it down that way, it's like, I got a 40% return. I used to do antiques and collectibles. I've collected things my whole life. So is my grandfather. So a lot of people in my family are all entrepreneurs. We've always collected things. I am pumped when I buy like a storage unit, or I buy something at an auction and I flip it and sell it, and I made like $300. I'm pumped. I'm like, dude, I just made $300. Like, I'm so excited. That might be a 45% return, but if it was in the millions of dollars range, you know, it's still a 45% return. It's just with bigger bills. And when he said that, I was like, yeah, that makes sense. Like, I'm pumped for $300 returns. You know, I was doing $4,000 weekends doing flea markets and like weekend garage sales or whatever. Like, we were doing $4,000 a month just on the weekend garage sales and flipping and all that. Our store ran, you know, 6 days a week, which brought in another set of, you know, few $1,000s, but investing is a crazy world, man. So
here's the question, Sean. You ready?
Yeah.
It is just about zeros at times. There's a lot of skill. There's a lot of management. There's a lot of things, you know, networking and things that go between X amount of zeros and much bigger. But the question is, why doesn't everyone do it? Does that make sense? The real question is, why doesn't everyone do it? And I'm going to challenge the idea that it's access. I think most people could figure out access. I think we live in a time where people are more accessible than they've ever been in human history. And I'm going to say that it's more about internal reasons and emotional reasons and mental reasons that people don't step into those more more dollar figure,
Sure.
bigger zero opportunities. That's where I see the biggest discrepancy today between why someone's doing X amount of zeros and why they're not doing 10X or 20X.
Would say it comes down to yes, but attributed to number one, risk. I'm playing with a couple $100. I'm playing with $10,000. It's like when you go to a casino and you're okay, what am I spending? I think I'm comfortable losing like $600 or $700, right? Like, okay, let's say the casino goes, I believe in you, and we're going to, let's say we're going to 100X. So we're not playing with 6 or 7,000. You're playing with $600,000. You're playing with 6 million. Here's a $6 million chip, and you're gonna play with the $6 million chip. People would go, I don't, because if you lose $1 million off it, you're like, the percentage hasn't changed. If you had $6,000 and you lost 1,000, you'd be upset.
Yeah.
If you had $6 million and you lost $1 million, right? It's a higher number. You lost the same amount of money at the same percentage.
But it's more complicated. I agree with you. I like
Yes,
let's
it's
use
the
the analogy
risk.
of a casino, right? It is risk. It is risk versus reward. But let's make it more complicated.
Okay.
What if, just to bring in inflation, right, which we've been dealing with since 2020 in a big
Yes.
way, what if you lost 9% of your chips every hand, right? What if there was a metric of the amount of money that you were losing to something, I don't know, we'll call it inflation, right? Just every hand, you lost a percentage of the amount of chips you had. So now you can't just be out on every hand, because if you are, what happens is you lose percentages of your worth, right? This complicates it for investors today, because where they're at in the middle of 2022, inflation was 9.1%. Okay. Now today it's a lot less. It's, mid low twos. Great. I'm glad that's more resolved than it was, but it's complicated for investors in unknown inflation environments because they're stuck between a rock and a hard place. On one hand, if they don't invest money, they literally lose money. If inflation is 9% and you hold cash, you lost 9% that year for doing nothing. You got punished. If inflation is 2 or 3%, you still lose 2 to 3% if you don't do anything. Not as bad as 9, but it's still a punishment over here, right?
Yep.
The other side is if you take too much risk and you go after too big of a reward, you could tap out too. You could lose a few hands and really put yourself in a bad financial situation. So that's why the Federal Reserve wants inflation to be around that 2%, is to make sure that people are incentivized to go spend money, to go consume, to go invest, to go spurn the economy on. We're a consumer-driven economy in the U.S., not like China, manufacturing driven, not like agriculture, like other parts of the world, consumer economy. So you have to balance that as an investor. You have to make more than inflation, but you can't go crazy and take too much risk. And, and then if you're in your retirement years, again, we work with a lot of boomers and very high net worths that have a lot to lose. So if that's the case, you won't get enough hands to usually build it back. So you have to be even more conservative so you don't tap out at the table. So that's it. I love that analogy for the market of where we're in today. So many unknowns. You don't know what all the cards are on the table. You don't know what other people are holding or what the house is holding. You don't know what the Federal Reserve is going to do, right? So all you can do is find your window of risk reward, beat inflation, find something consistent in the middle.
Yeah, absolutely. So we talk about a lot of the money part. So let's talk about the monetization. So you got the income fund. You got your investments. How did you first start monetizing, and is it different than it is now? Did you have the numbers? Did you kind of know, like, I know how the game is played, because you kind of have to know the rules, right? Like we're talking about as you explain it more, I'm loving this casino thing. Like, I have to know what the payouts are. If I'm doubling down on something, am I doubling my investment? If I get on blackjack, I get 2 8s. Am I splitting that investment into 2 and I'm playing double hands? Am I paying more to the pot? Like what's the game? What is the monetization game that you're playing in?
Yeah. So good news and bad news. Bad news is I actually don't gamble other than like craps with
Right.
friends or something just for
I
fun.
only do
So I'm going to
slots.
run out of analogies for that side. I'm going to get ahead of that. But what I will say is this, the monetization side, we've built and sold a number of businesses, long entrepreneurial career, in addition to a long real estate career. What I'll say is this with 100% confidence from my experience. Monetization's a little bit different in every industry. It's most about, though, what they all have in common is finding the real levers, finding the real juice in that particular industry. Okay. Early on in real estate, in my career, there were a lot of deals and there wasn't a lot of money. Nobody wanted to invest after 2008. Almost every deal you bought, you could make a lot of money, but nobody had the money to do it, right? Today, it's reversed. There's a mountain of money out there. There's literally trillions. But the issue is there's no returns and there's a lot of risk for less returns, right? So you look at multifamily, which is a privileged asset class backed by the government in so many ways, great debt. The issue is there's 20 bidders on every property. So it's overly competitive. The water's too frothy, right? That said, there are opportunities, but it's about finding the juice. Where we find the juice today, where we find the biggest opportunity in what we're doing is niching down through our acquisitions, is niching down into good partnerships and doing things that really set us apart where people can't compete at the same level. I am not going to bid on a multifamily building when there's 19 other offers. We are just out, right? We are just out. We're going to go find somewhere else to compete better where it's less competitive. And it's not about being less competitive as a landscape. It's being about less competitive and finding greener pastures, bluer oceans. So for us,
yes,
the note space, the mortgage space, we're very confident with our relationships there. It's very relationship driven, but also we carve out a good niche for the right people that we want to work with. Other people and other sides, I think, need to understand what their biggest opportunities are in their industries. A lot of times that's going to be pricing, especially for product driven businesses. It's where are they pricing at? Because you can't lower your price to zero, right? Even though the consumer, the buyer of the product would like a zero price point on everything, that would be ideal. Everything's free, right? But the reality is for the business owner, for the seller, that's a very bad situation. So oftentimes it's raising price. If you look at people like Warren Buffett, he pretty much gives his companies free reign, but continually in his agreements, he says that he's the final say on price, right? For us, we are very confident. We're very competitive on our returns to our investors, and we're very confident we have a good yield. So our pricing is more structured. And so how we monetized was really being really close to very successful people, asking them what their needs are, and then fulfilling their needs. We want to keep it as streamlined as possible, open communication as possible, with the right people as possible, with as close to our right person as possible. If I was going to go back and do it again in a different market, and I was to test what that would look like, I would be doing things like Facebook ad testing categories. I'd have multiple campaigns and a category testing. Does this messaging work with these type of people? Is this price point working with this demographic? Is this working here? Does anyone give a crap about this product at all? Or is it just going off the charts and we need to mass produce? So I think testing it and knowing how to get the information to make sure that when you monetize, you land on the right price. It's the right product that has a lot of leverage and the ability to do that. And then I think you really can scale to the moon with lead gen and nurturing.
Articulated. Love that. Have you heard of rental arbitrage?
If it's what I think it is, yes. It's kind of a sandwich lease where you lease maybe like a floor of a building and then you go and Airbnb it out kind of thing, or like something similar to that.
Yeah.
Is that the concept?
Similar to that, yeah. So you can do buildings, you can do like it's right. So I got some friends that do this, and they rent a house, or they'll rent a whole floor of multiple doors of like a condo building or whatever, right? Or like when they're building a new apartment building, condo building, whatever, they will say, I want this whole floor on this side. And it's not necessarily the top floor, but they're like, I want the third and the fourth floors, whatever. And what they do is they act as the property management company, and they will Airbnb the house and they'll make sure the rent's paid and all the things. The upside of that, I was looking at some of the upside on this is absolutely stupid insane. You know, your rent is $1,500, but your Airbnb is bringing in $3,300, but you have a $2,000 profit every month. Are you kidding me? If you had 10 of those units, you know, you're looking at 20 grand a month. If you had just had 10 units, 20 grand a month, if all of them did the same
one
thing.
address. Yep.
For what, dude, I'm like, what? Like, stupid. You know, I'm like, I'm literally, I'm in the wrong game. Like, I am convinced that I am on the wrong side of history and the wrong game. I am not making millions of dollars, but I will tell you that sitting here today at 41, I'm comfortable though. Like I don't need, I mean, everybody wants $1 million, right? Everybody wants to close that the high of the deal, you know, that Wolf of Wall Street mentality, you know. But then I listened to him some more, and he's got to evict somebody, you know, because they started squatting in one of his Airbnbs. And then this other guy, they had a party and some holes got pushed into walls. And then the Airbnb doesn't want to like do anything. And so there's always like the glamour side of like, we just closed a $500 million deal. But like there's stories that go into all these like investors. It was a 2-year court battle. We spent thousands of dollars to try to get the property. And now we're like stressing because we have to recoup that money now. And it's like, you know, nothing. I'm convinced that nothing is all sunshine and rainbows and super easy. There's always going to be something. But
I think it has to be the hard road.
Yes, but Tom Hanks in the movie, we have to close on some movie quotes, right? So Tom Hanks in A League of Their Own tells Gina Davis at the end, he goes, "Of course it's hard. If it wasn't hard, everybody would do it. The hard is what makes it great." That's what makes it great.
I love that. I agree. I couldn't agree more. I think that's where people fall off and they don't stay the course, but the opportunities are there. We live with more opportunity today than we've ever had. I truly believe that.
Yeah. So then I looked into, as we close, which doesn't really mean anything, but it gives the listeners hope that we're almost done. He said something about the court steps. I watched a guy probably 10 years ago at like 2:00 in the morning. You know, he's like, "Oh, I paid $700 for my house because I just paid off the back taxes and now I own it." And I'm like, I don't think that's actually how it works. Like, he had this whole program, this online course, this whole book, and he's like, "How much did I pay for that house? $700. How much was that one? Oh, but wait, there's more." Yeah, you know, like I looked into like paying off back taxes, and I know somebody who used to do that, and these houses are bad. Like, walls busted out, windows busted out, distressed beyond, I mean, you might as well just knock it down type of, you know, like property. If it was acreage, maybe it would make sense. But I thought about doing that as an investment. I've dreamed of flipping houses. I've just never done it because mental and emotional reasons, right? There's a lot of risk. It's a lot of work. It's a lot of money. So I've never done it. But if I had, you know, we always say if you had unlimited resources, what would you do? I'd buy and flip houses. I would rehab homes. I would do the taxes. I would pay off the bank. I would do all of that.
I love that. I love that. We had a similar model as like a Burr model. You know, what is it? Buy, rehab, rent, refinance, repeat, right? Yeah. So we did that with commercial buildings. And so it was the same model, just more zeros. And so I couldn't, you know, I was, my arm was twisted with my partners. They said, "Nick, we don't have time for small deals. We literally don't have literal time for small deals. So it has to be commercial. It has to be above X million." So that's what we did over and over and over and over. And it was so successful that they said, "Look, we've done enough deals. You know, we want to, you know, be more passive." So I love the model of the fix and flip side. I was pulled to a different direction, you know, to a different asset class for the reasons that I said, but there's money there. In Michigan, where you're at, Sean, there's a lot of markets that are doing really good in Michigan. Detroit taking a lot of crap for the last 10 years or so. It's a different Detroit today. It's a different Michigan. Michigan's very much bouncing back in a huge way, kicking butt. I'm still praying that the Red Wings get back in the cup. We get we string together some victories for the Stanley
Tigers
Cup.
Just made the playoffs for the first time in like 10 years, and then the Detroit Lions go to like the NFC Championship game for the first time in like 30 something years. I mean, I think we're getting there. The Pistons are a complete loss. We don't worry about the Pistons.
Written off. They're written off for now.
We're written off.
Yeah.
But everything's moved to Detroit now. The Palace of Auburn Hills is gone. Pontiac Silverdome is gone. Everything, the Joe Louis Arena was, in Detroit, but that's even gone. Like everything is all concentrated in the same place. Ford Field next to Tiger Stadium, next to the Little Caesars Arena. It's all the same thing now. And the Pistons play at the Little Caesars Arena, and like it's all of that. So Detroit definitely bouncing back. Michigan definitely bouncing back. I found really nice houses for not a whole lot of money. I lived in Utah, and you couldn't find something for under $500,000. I found a very nice 3-bedroom, 2-bath, something real nice in Port Huron, right by the bridge, right by the lake, 169. I'm like, there's no way. No, and it's nice. It's an old house, right? But like for like a starter home for a 22-year-old that just got married, that'd be perfect for them. 169,999. Let's go.
Yep.
So you're absolutely right, man. This has been an excellent conversation. Thank you for your time. Thank you for sharing everything that you have. Where should the listeners go if they want to learn more about you, either just by learning what you're doing, or if they wanted to invest in your group? If I got a lot of real estate friends, I'm going to show this episode to. If they want to invest, if they want to get started, where should they go? And is it the same if someone just wants to learn about you guys?
Yeah. So we give everything away for free. We spend so much time doing economic deep dives and strategic analysis on different investment strategies in different markets and different market analysis. We give it all away for free just to educate people. It's kind of a passion of ours to give back in that way. People can find all of our free webinars, all of our free resources, an economic tracker that shows all the updates on the economy at saintinvestment.com/resources, saintinvestment.com/resources. We give it all away. We host live webinars, and they can also find how to invest if they want to take the next steps.
That's amazing. Absolutely amazing. I will definitely show this to my real estate investing friends. I will make a email intro to Scott Carson. You guys can get connected there. Nick, this is absolutely phenomenal. You are a heck of a dude, and I just wish you the best in whatever comes your way.